Bonjour à tous, bienvenue à...
Good morning, everybody. Welcome to Ottawa. I am Stephen Tapp. I am the Chief Economist. It's a pleasure, as Carl mentioned, to be here in person for this general meeting.
To welcome John Graham to the stage for our opening keynote session. John is the President and CEO of CPP Investments, a position that he's held since February 2021. John is responsible for leading CPP Investments, and its mandate is extremely important to everybody in this room today. That is ensuring that Canadians have a strong foundation for financial security in their retirement. John joined CPP Investments in 2008 and has held a series of senior positions, including in total fund management, private investments, principal credit, and he was the global head in principal credit investments before he took on his current position. Under John's leadership, CPP Investments has increased its exposure to emerging markets, and he has worked around the world in Toronto, in London, and in Hong Kong. I'm not going to detail John's education, but I'm simply going to say that he chose wisely to attend Western University in my hometown, London, Ontario. You may hear more about that in his speech. I would also mention that there'll be questions towards the end, and we have Slido. I'll mention the hashtag later, but it will be AGM 2022, where you can pose your questions for our Q&A. With that, John, the floor is yours. Thank you very much.
Great. Well, thank you very much, Stephen, for that very kind introduction. And good morning, everyone. I am delighted to be here. I'm delighted to be here in Ottawa. It's actually my hometown. London's not my hometown. Actually, Ottawa is my hometown. I did grow up here. I did go to Western University. But I'm also very delighted to be here in such great company. Such great company as we look ahead to the future of business success here in Canada. Now, charting that path to success, charting that path to the future is anything but straightforward right now. And in preparing for today and reflecting on my career, I actually started out as a research scientist. I have a PhD in chemistry. I didn't start my professional career as an investor. And in those days, as a chemist, which was quite a while ago, I have been with CPP Investments for almost 15 years, the concept of volatility, the concept of volatile substances, it meant something very different to me as a chemist. But it did train me to handle volatility with care, trained me in the role of planning and the role of prudent risk management. It also taught me that when volatility is handled properly, it can lead to really innovative outcomes. So today, as we seek to manage volatility in the investing markets, we at CPP Investments see many factors at play. And these factors are changing. They're changing day by day, hour by hour, and at times it feels minute by minute. And this volatility that we're all experiencing, it is having a dramatic impact on the global economy. And while we at CPP Investments, we're certainly paying close attention to current events, we also keep one eye firmly fixed on the future. As the investor of the CPP Fund, the largest single pool of capital in the country, CPP Investments plays a vital role in the financial security of 21 million working and retired Canadians. So thinking about the future, planning for the future, it's what we do. And my message to all of you is this: we are going to continue to face headwinds in the economy. But as always, those challenges, those headwinds will create new opportunities. As patient investors, by design, CPP Investments will continue to do our part so our futures, so our children's futures will be well supported. Today, for my prepared remarks, I'll cover three areas. First, a few comments on the current global macroeconomic landscape. Secondly, what we're seeing as investors. And finally, how we at CPP Investments are navigating this volatility. Then I will have an ask of you. As leaders of the Canadian business community, you represent millions of employees and households across the country. And you know that confidence is the lifeblood of stable, dynamic commerce. Now, unfortunately, we're all hearing a lot of bad news lately. But Canada has a healthy retirement foundation, one of the best in the world. And it's my hope that you will come away with a renewed sense of confidence. in how we are investing the CPP fund and in the future retirement outlook in Canada. And ultimately, that you can help share that story across this great country. So first, I'll talk a little bit about the global economy. And it's been a choppy year, and it's probably been a couple of choppy years, with wild swings in the markets, increased geopolitical tensions, persistent inflation, and it is looking like a different world post-COVID. And you've already heard the facts and the figures, and you actually probably know them a lot better than I do. But I'll reference a few for context. Last year, when Tiff Macklem addressed this group, he said that at close to 5%, inflation was too high and above Canada's target of 2%. Today, a year later, inflation is both higher and more persistent. In June, we hit a 39-year high, and the Bank of Canada isn't anticipating getting back to target until 2024 and maybe the end of 2024. Meanwhile, in the US, they hit a 40-year high in June at 9.1% and released figures yesterday showing core inflation still high. And Europe, it doesn't look good, and many countries still very dependent on Russian gas. So as different parts of the world look to tackle inflation, most central banks, as expected, are aggressively increasing interest rates. Currencies are swinging wildly. The British pound is near the bottom of the list. And the US dollar continues to surge, continues to strengthen, a real flight to the US dollar, triggering relative value lows for many currencies around the world. All of this is further complicated by the continued supply chain challenges and geopolitical tensions which are running hot. And all signs point to slower global growth and speculation of a global recession next year. One of the most dramatic drops is probably in China, where a combination of the COVID lockdowns and systemic challenges in the economy have led to slower than anticipated growth. So against that backdrop, the second thing I'll cover is what we're seeing as investors, and it will get better, it will get more cheery as the speech goes on, but as investors, we assess the impact and the forces behind these changes and events, and look to identify both the risks and the opportunities, and a number are surfacing, and I will highlight a few. Deglobalization is happening. It's been happening for a few years. It's probably accelerating in a post-COVID world. After decades of globalization, we're seeing that shift to deglobalization. And this is very much in response to some of the challenges I mentioned at the outset, ranging from fragility in supply chains to geopolitical factors. And one of the major trends we're watching going forward is countries continuing to align economic policy, industrial policy with national security interests. The result is that onshore, local investment opportunities in specific strategic sectors are emerging, whether they be semiconductors, batteries, artificial intelligence, big data, active pharmaceutical ingredients, vaccines. We're seeing increased opportunities. The news over the weekend around the Semiconductor Act and the CHIPS Act in the US is another example of industrial policy aligning with national security interests. In a somewhat related vein, the energy crisis in Europe is proving to be another catalyst for the energy transition, really highlighting that this is a transition, and this is going to be a non-linear transition. Fuels such as natural gas are going to play an important role in the global economy for years to come. But the world is investing heavily in the transition to a low-carbon future. Last year, around $755 billion was spent globally in the energy transition. Actually, China spent the most, then the US. Looking at Europe, between the UK, Germany, and France, they spent a combined $150 billion in the energy transition. CPP Investments' approach to sustainability and our net zero commitment considers the role we can play. The role we can play in assisting companies as they map their transitions and how we can support them through it. We're investing in areas like stationary energy storage, in an exciting Toronto-based company called Hydrostar. And in the UK, we have a strategic partnership with Octopus Energy Group, and they deliver customer-focused, affordable green energy services in the UK. Now, those of you who may be interested in how we're investing in the transition and what we're doing with respect to sustainability, we just released our Sustainable Investing Report 2 weeks ago, and it's available on our website. Well, we talk a lot about the energy transition, but this just isn't an energy transition. It's a whole economy transition. The entire economy, over time, will transition to a low-carbon future. And climate-related spending, infrastructure investment, are likely to continue to grow too, aided in part by long-lasting federal spending programs, particularly some that have been announced in the US recently. Now, as investors, we're also keeping a close eye on the labor markets, consumer spending, and seeing changes in a post-COVID world. Within those broader themes, we know there are opportunities to make investments at attractive entry points. Market volatility presents good opportunities for long-term investors such as us. As patient, active investors, we're focused on identifying opportunities with the right capabilities to succeed in any market environment. Because when any market correction happens, and they will happen again, strong individual companies emerge from the pack. One thing that's slightly different right now in what we're going through is many investors around the globe have an abundance of dry powder. This is cash sitting on the sidelines waiting to be invested in certain markets. In certain markets, capital is a little bit of a commodity. And CPP Investments works very hard to differentiate ourselves like any other business operating in a competitive market. Which leads me to my third and final message for you today, that CPP Investments is built for times like this. We were set up to create value over the long term and to be resilient in the face of wide-ranging market and economic conditions. Now, that doesn't mean we're immune to market volatility. It means that we're well-positioned to weather the storm over the long run. And the key is active management and diversification. We diversify across asset classes, we diversify across geographies to mitigate concentration risk and to deliver a stronger and more resilient portfolio. We invest across a wide range of asset classes with very much the expectation that they will perform differently through the economic cycle. Now, here's a quick snapshot on how we're performing. In the first quarter of fiscal 23, so we have a March 31st year end, so our first quarter of fiscal 23 ended at June 30th of this year. The fund achieved a 5-year and a 10-year annualized net return of 8.7% and 10.3% respectively. So we have a 10-year compounded annual return after all costs of 10.3%, which is very strong long-term performance. For the quarter itself, we returned negative 4.2%. So we're not immune to the market volatility, but putting that in context, that outperformed global equity indices, which were down well into the double-digit territory. And we continue to outperform the market, adding over $40 billion of what we call cumulative dollar value added. So this is money that's in the fund in excess of whether it was just passively invested above all costs. So over $40 billion over the past 10 years. We're also constantly making sure we stay at our long-term risk target and that we constantly stay in market looking for opportunities. You know, we are not market timers. We stay in market all the time. One of the most important investment decisions an institutional investor can make is to not lose conviction in your long-term beliefs during a market sell-off. And that means buying equities when equities are selling off. We also take a thoughtful approach in the investment ownership structures we adopt, especially on the private side and in our approach to governance. We invest a tremendous amount of time up front with potential investments, allowing us to be an active, engaged partner through an entire investment's life cycle. We can be with a company when it's private. We can be with a company when it goes public through an initial public offering, and we can be with a company when it's public afterwards. And this allows us to maximize value and to really time and think about how we can add value and maximize our returns through the whole period. Now, perhaps we suffer from Canadian humbleness, but many Canadians are actually not aware that they have a very well-respected global investment firm successfully working for them and for their retirement. And they should take comfort knowing that CPP Investments is viewed globally as one of the best in the world. As one of the highest performing global institutional investors, we do get a few headlines, whether it's in The Economist, and I'll read the headline, "Moose in the market that other countries seek to emulate," whereas the Washington Post referred to us as the most popular pension fund in the world. In some ways, we continue to be one of the country's best kept secrets. So in conclusion, looking ahead, I remain cautiously optimistic. Yes, we anticipate a continued bumpy road ahead. We are quite cautious on the markets right now. Yet we are optimistic and frankly confident in CPP Investments' ability to navigate the volatility in the markets and add value for 21 million workers and retirees across the country. As investors, we look for the big themes and opportunities that emerge, and I'm sure many of you are seeing similar opportunities for your own businesses. While doing so, please rest assured that CPP Investments is dedicated to continuing to deliver the kind of sustained value we all need to ensure peace of mind in the decades ahead. Now, I reiterate my hope that you will help spread that message to people who look to you for reassurance about the future. Certainly very grateful for people like you here today who are gathering to do the thinking, the planning, and to create successful businesses and real opportunities for Canadians, ultimately strengthen the role of Canadian businesses around the world. Thank you.
As we go. So thanks for that opening remarks, John. What I wanted to start with was probably the biggest change in terms of financial markets that we've seen over the last year or so has been the relentless move by central banks to increase interest rates. People, you mentioned before, Tiff Macklem, thinking maybe inflation would peak around 4 or 5%, and then it kind of kept going up and going up. Then we had the war happening in the Ukraine, and things started to get worse in energy markets. So my question is just, in the environment now where interest rates have gone, a couple years ago at the effective lower bounds to stimulate, now we're going back above neutral into more restrictive territories. What's the impact of higher interest rates what does that have on a pension fund like yours? What does it mean for you guys?
Let me make a few comments, and I will speak mainly to what it means for CPP investments, but maybe just first starting with inflation and going through this journey. And I'd say we probably, as an organization, also underestimated how persistent inflation would be. We thought it would be more transient, recognizing that transient is not a very helpful word because it does have a time component to it. If you wait long enough, everything is transient. But we certainly now view it as more persistent, and but are confident that it will come back to target in time. We've been fielding a lot of questions over the past few weeks around the impact of inflation and rising rates on pension plans, partly due to the news that's coming out of the UK. And they're in a very different situation than we are, so we're just different. There you have a lot of liability-driven investing, and so a real sensitivity to a dramatic increase in interest rates and long-dated interest rates. So how CPP Investments is impacted by interest rates and by inflation, because of who we are, because of how the Canada Pension Plan is structured. It's a hybrid plan, which means that as contributions come in from working Canadians, the majority of that capital immediately goes out to pay benefits, and there's a small excess that will be provided to the CPP Investments, and then we invest on behalf of the 21 million Canadian contributors and beneficiaries and look to grow the fund. Because of how that works, our sensitivity is not as great to inflation as many other plans would be. Obviously, interest rates and inflation will impact the asset side of the equation. We just have to look into the capital markets, both the bond markets and the equity markets, to see that interest rates and inflation are having a negative impact. It also has the impact of reducing the net present value of your liabilities. So on a net basis, we're not as impacted. Other organizations around the world, as I mentioned, will be more impacted than CPP Investments.
Okay. You mentioned, we talked before about kind of what the outlook is for the global economy right now. It's obviously pretty dire. The IMF had the World Economic Outlook, and their meeting's happening this week. And globally, looking across probably recessions in most or 35% economies in their forecast, but also kind of things stalling out in the US and China and Europe and the major economies in the world. So short term, kind of very cautious, very slow, but as you mentioned, longer term, you guys are seeing kind of a more optimistic outlook. So I'm just thinking across, we have the advanced economies and the emerging markets. Obviously, you guys have increased your exposures to emerging markets, thinking that growth is going to be stronger there. Are you reassessing that, or are you thinking the longer term prospects have changed now for countries, let's say China, given property asset price issues? The COVID-0 policies, if you want to go back to the transitory phrase, they're probably transitory in the sense that we will get past the pandemic. But do you see more systemic problems, or are you still pretty bullish on longer term prospects for emerging markets to recover and to keep growing faster than advanced economies have over longer term?
Yeah, and maybe I'll share just a little bit how we think about building the portfolio, how we think about portfolio construction. So as of June, the assets under management were $523 billion and continuing to grow. And we had made the decision probably about a decade ago that we should be a global investor, that we should have the capabilities, the infrastructure, the relationships to invest in the large economies around the world, with the view that this was not only going to provide interesting investment opportunities to outperform the market, but it was going to provide diversification. It was actually good, sound, almost risk management to diversify the portfolio across the big, large global economies, with the expectation that some economies will be performing well when others are probably lagging, and vice versa. So as we have been building this out, we have 8 offices outside of Toronto, and really have built capabilities and the understanding to invest in the big economies in the world. And we take a very long-term approach. And so we don't look to tactically move in and out of markets. We look to build the relationships, the understanding of the markets, and kind of be there through the economic cycle. So we have a very long-term view on how we think our geographic allocation should work, how we think our asset class allocation should work. But then in many ways, we build the investment portfolio from the bottom up. So you think about some of these emerging markets that you touched on. Emerging markets have been growing at a faster rate than developed markets for a while. And I think about it that if we want to be a global investor, it's very hard to hold your hand on your heart and say you're a global investor if you don't invest in the largest economies in the world. If you kind of carve away what will be 50% of global GDP. And so maintaining that ability to invest in these markets. But the how really matters. And so we build the portfolios up almost security by security. And going through a pretty rigorous diligence process and thinking about how we would invest in different opportunities in all the geographies we invest in.
Yeah, and just on the asset allocation side, can you just talk a little bit about how does CPP spread the overall portfolio? You mentioned $525 billion. It's a lot of money. So how do you allocate across, let's say, infrastructure projects, private equity, credit, just general equity? What's the overall allocation process at this point?
Yeah, and at $523 billion, and with a very long-term horizon, we actually maintain a relatively stable asset allocation. We're not market timers. We don't try to come in and out of asset classes quickly with a view that kind of gives you the opportunity to be wrong twice, coming in and coming out. So we have a long-term view of what we take infrastructure as an example, and infrastructure is incredibly topical right now because many infrastructure assets have inflation protection built into them. So there's a real desire for institutional investors to get into infrastructure right now. We've been in infrastructure for 10, 15 years and built, I think, a fantastic portfolio. And so we have a lot of that inflation protection, but we were building it over the past 10, 15 years. It may take a year or two to even find an investment and close it, so it's very hard to be quite dynamic. So as I sit here today, we think about how much do we want in private investments, how much do we want in public investments. Why do we invest in an asset class? We invest in infrastructure for stable contractual cash flows that can have inflation protection in them. Why do we invest in real estate? Why do we invest in equities? And we actually take a 25-year view on how we think that asset allocation should be.
And are you in any crypto? any of the newfangled finance assets?
Yeah.
Or are you guys staying very clear away from that whole thing?
Yeah, I get asked that question a lot. Whether we invest in crypto. We don't invest in crypto. It consumes a disproportionate amount of discussion time for the allocation we have to it, which is zero.
And the media love to report on it, given the volatility. So,
Yeah.
okay, maybe talk a bit about you had the sustainable investing report that was
Yeah.
published recently on your website by your organization. Can you just talk a little bit how are climate change, energy risks, how do those things get factored into the decision making that happens at CPP Investments?
Yeah. So I'll go through how we incorporate it into our day-to-day, but I'd like to spend a little bit of time on our net zero commitment that we made earlier this year. And earlier this year, it was one of the first things I did when I came into this seat was to really think about the portfolio and think about the carbon intensity of the portfolio. And we made a net zero commitment that we'll have the portfolio net zero by 2050. But our net zero commitment is a very, I would say, made for CPP Investments net zero commitment. A few things that I would highlight is, one, we do not believe in blanket divestment. We actually continue to invest in oil and gas. We continue to invest in extractive industries with a view that this is a transition. And we need to support the industry, and it's a critical industry, through the transition. We also believe there's a tremendous investment opportunity of investing in, call them, carbon-intensive industries. Cement, steel, transportation, aviation. These are critical sectors to the global economy. And I believe the global economy will do what it can to transition to net zero. And we want to be an investor who works with the companies, invests in the companies, and invests in their transition to net zero. We don't believe divestment is ultimately constructive. We take approach of trying to be a engaged investor and investing and supporting companies through the transition. And I do believe that the world will do what it can to try to get to net zero by 2050. And this is going to present a generational investment opportunity. I mentioned $755 billion was spent last year on the energy transition. That's actually way too low. It needs to be way higher than that. And I hear numbers of 50 trillion, 60 trillion, $100 trillion. I don't know what the number is, but it's a big number. The critical infrastructure that needs to be built is staggering. So we came to the view that let's transition away from thinking about climate as a risk and thinking about it as a huge investment opportunity. And we felt it was important to make the net zero commitment, important to make one that was CPP investment centric for the reason I just described. And we call it internally our Gray to Green strategy of investing in green assets and supporting them to become green. But really thinking about that tremendous investment opportunity. So how we do it internally is we do it from both the opportunity scanning side and the risk management side. We look at physical risk, we look at transition risk. All our material assets in the portfolio go through a screen. All new investments go through a screen. And continuously looking at the portfolio. And for our public positions, we also do share that we respect the role of an investor versus the role of the board and management. It's management and the board's job to develop the strategy. But if we don't believe a company has a viable transition plan, we may vote against the reappointment on the risk committee at the board of directors level. But ultimately, we do view this as a tremendous opportunity, but a tremendous opportunity for the whole economy.
There's a follow-up here from Paul Basanti from Slido, just talking more back on the asset classes question, but are there any asset classes CVP Fund is essentially trying to move away from? I know you said it's pretty stable over time. Have you, actively tried to reduce your exposures to certain asset classes over, let's say, since before the pandemic, for example?
Yeah, I would say if and I don't want to get technical, that maybe it's a definition of an asset class. The large asset classes, what I'd call the franchise asset classes, infrastructure, real estate, private equity, credit, public equities, the short answer is no. Within those asset classes, there are repositioning of the portfolio. Repositioning of the portfolio to find areas where we think will be better suited for a world post-COVID. If I look at our real estate portfolio, which had been transitioning for years, one of the really good things the team had done is really transitioned years ago away from retail in some ways, the brick and mortar, and into logistics and into data centers, which played well in the early days of COVID. So within each asset class, the portfolios are moving, and maybe it's sub-asset classes, but thinking about where the best investment opportunities may be.
Yeah. Okay. So there's a question from John on ESG. I know we talked a little bit about ESG, but more generally, just how does CPP approach ESG factors in their investments? I know you talked about this a little bit, but if you want to add anything further.
Yeah, and so, again, maybe I'll just go through a little bit to how we think about it internally. And I think it's important that we incorporate ESG factors. And ESG is a term, it encompasses so much. With the environmental, the social, and the governance, it encompasses so much. It's almost, we rarely will talk of it as ESG. We tend to talk more about the environmental side, the governance side, and the social side. So increasingly, we're even incorporating it into our high-level investment decisions and high-level how we think about allocating capital. Then it gets incorporated, as I mentioned, into our security selection. Every time we look at a material transaction, incorporating the factors and just continuously reviewing the existing positions in the portfolio to see if anything changed.
And can you talk a bit more on the governance side, just diversity, equity, inclusion, sort of measures that have been taken at CPP Investments on the board side? Yeah,
and I'm happy to. And this is an area that, long before I was in the seat, but an area that we have been really focused on. And I can talk a little bit about what we do internally, but also how we think about managing the portfolio in our positions. So on the public side, for years, we have been an advocate that there needs to be greater diversity on boards. And if there is not gender representation on a board, we will vote against the reappointment of the nominating committee chair and other board members. And we started this in Canada, moved it to other developed markets, and every year we're rolling out our kind of voting principles. And if people are interested, this is also covered in our sustainable investing report, how we vote with respect to gender diversity on boards. And so I think it's been a reasonably successful program. We also have a relatively large private program and again, view that diversity on boards leads to better decisions. It's the right business decision. And so an expectation that the boards of companies that we have influence, we have diversity on the board. Internally at CPP Investments, our board has really strong gender diversity at 50-50. And we look through 4 different categories as we think about CPP Investments: gender diversity, minorities, LGBTQ+, and people with disabilities. These are the 4 that we've been focused on right now. We've made a lot of progress over the past few years on gender. We're approaching kind of gender parity within the global workforce, but I'd say we still have work to do within the senior investing ranks. We have an aspiration we want to get to, and we're not there. We're continuing to work on that. The minority side, we've made quite a bit of progress on that over the past few years. And on the LGBTQ+ and the people with disabilities, including mental health, this is one where I'm particularly proud that people have to self-disclose. And we've seen a real increase one of the things we say is we want people to be able to come to CPP Investments, bring their whole self to work, and just be able to realize their full potential. by being themselves at work. And we've seen a real increase in people disclosing mental health issues or disclosing LGBTQ+. And during COVID, I think many people have been impacted by mental health, and many people's families have been impacted by mental health. And we're actually seeing just a much more open, constructive discussion along those dimensions.
Agreed. So Jeff from Slido, a question here just on overall demographics. So he says we got about 20% of Canadians now close to retirement, baby boom generation exiting the labor force, increased life expectancy as well. So how do the overall demographic trends impact, let's say, the sustainability of the CPP fund overall?
Yeah, it's a great question. And it'll give me an opportunity to give a little bit of history on CPP investments in the CPP fund, which I think is one of the greatest examples in this country of provincial and federal cooperation. And if you go back to the creation of the CPP.
Well, I remember you used to be called CPPIB.
We used to be called CPP.
Back in the day when I was in undergrad, that's what we called CPPIB.
Yeah, that's still technically our name.
Okay.
We go by. But when CPP was created in the 60s, it was at a time when there was a real crisis in poverty and retirement. 50% of Canadians, retired Canadians, were living in poverty. And for single Canadians, it was actually approaching 75%. And CPP, along with other kind of federal programs, did a tremendous job addressing what was really a crisis of poverty among retirees. But as the dependency ratio dropped, as the birth rate dropped and people started to live longer, in the 90s, there's a recognition that there was the CPP needed to evolve. And that's when they created CPP investments, right? And they created CPP investments. They restructured a little bit the contribution, the benefits, and created CPP investments with the goal of taking the funds, having them be managed by an arm's length professional money manager with the sole purpose of maximizing return without undue risk of loss. No government interference in investing. Just take the surplus funds, invest them on behalf of Canadian workers and retirees, and maximize the value of this pool, which today sits at $523 billion. And the latest report from the chief actuary showed that the CPP is sustainable for 75 more years. And it's 75 because they don't go beyond 75. And this is a tremendous, I think, accomplishment. Again, it's one of the great examples of provincial and federal cooperation, because CPP in many ways is a collection of provincial contributions to the plan. And we still occasionally hear that myth that CPP is not sustainable, and it's just not true.
Yeah, that's the odd thing. I was at Parliamentary Budget Office, and we did similar 75-year projections, these long-term fiscal sustainability reports. And CPP and QPP were the one area that we have no concern at all about. It's more on the provincial side in terms of government funding and the spending pressures and demographics. But you do still hear this from younger generations or others that have the sense that, well, this system can't make sense because we have all these people retiring. So is that just a myth or a communications challenge for your side?
Yeah, it's a myth today. Absolutely, and since the creation of CPP investments, the CPP has been sustainable for 75 more years. It's one of the reasons that we love to get in front of audiences like this, and it was a little bit of my ask, share the message that CPP is sustainable for at least 75 more years. And we do get out there and we try to share that message, because it is important that as people think about their retirement, they think about planning for the retirement. And CPP is only one leg in retirement. You have defined benefits, which are very rare these days, defined contribution plans, RRSPs, savings. CPP is a pretty important part of many people's retirement, and again, becoming an increasingly important part. And we try to get out there and share the message that it is sustainable, and for at least 75 more years.
Yeah, there's definitely been a shift. There's always the public-private shift, but definitely more to DC, so defined contribution, so people really more taking on individual risk as opposed to more defined benefit programs where you would have a set and known lifestyle in retirement. Do you think that there may be a pendulum swing back towards more DB, like defined benefit programs, given competition for labor, or do you think that these general trends towards it's more defined contribution and more individual responsibility, do you think that those trends are going to continue given the demographic changes that we have happening?
I've never been asked that question.
I
don't
have that question written down that I told you before. I apologize for that.
It's an interesting question, and I will speak just from my own personal perspective here. I think the transition from DB to DC was exactly as you mentioned. It is pushing some of the investment risk onto the employee. I don't see that reversing over time.
Yeah, I had noticed that at least some in the more public sector and Crown Corps and others where you're seeing as a selling feature the DB. Okay, so a question from Stan on Slido talks a bit more generally about how do you protect investment risks? You mentioned deglobalization, but here there's more hostility towards Western economies. So let's say you have investments in certain areas. Do you see the reshoring, onshoring, or just potential to fragment in overall supply chains? How does that impact your overall allocation of assets and how you strategize?
Yeah, as I mentioned, I think it is one of the big trends that we're watching, one of the big trends that we're thinking through. And how that works into our thinking is in some ways where we're seeing the investment opportunities and where we're focusing our time. And as I mentioned, we build the portfolio in many ways bottom up, security by security, and thinking about what is the kind of long-term prospect of this business. Now, I will say, though, that we still are a big believer in trade, and there's still a tremendous amount of trade that happens across the globe. And in fact, just over the past year, we acquired Ports America Group, which is the largest port owner in the U.S. So we obviously are still a big believer in trade and the value of trade.
And they've been busy over the last couple of years.
They've been busy. Yeah, and we're also an investor in Associated British Ports in the UK. So we are a big believer in trade, but look for these trends, and specifically, as I mentioned, around some of the strategic industries.
Can we talk a bit about how does Canada's overall pension scheme and how it's set up, or even the CPP-IB initial setup? How does that compare? Are there other countries in the world that are doing similar types of approaches to manage overall public retirement?
Yeah, and I'm obviously biased here, right? I obviously have a biased perspective. But in many ways, the CPP investments is the envy of the world. The federal and provincial governments created CPP investments to be a professional money manager that operates with no government interference in our investment activities. To take the funds at $523 billion, obviously a substantial pool of capital, and we have a sole fiduciary mandate to maximize return without undue risk of loss, taking into account the factors that impact the funding of the plan. And that's a tremendous accomplishment, and all of that capital ultimately goes to Canadian contributors and beneficiaries. Over the past 10 years, of that 500 billion, over 300 billion is net income in the portfolio. So it's actually returns that have been generated. And that 300 billion will go to contributors and beneficiaries because the money is solely for the purpose of the Canada Pension Plan.
Okay, I'm looking at my timer now, and I feel like this is probably going to be our last question. So maybe I'll skip more to the career journey question that I had set up. Thinking about you came to the role of CEO during the pandemic. I'm sure we have some other business leaders similarly trying to manage during the pandemic. Do you have any advice or just general reflections on what it's been like to take and assume responsibility during these interesting and challenging times?
Yeah, and it certainly has been an interesting time to assume the role, not just with the pandemic, but some of the market volatility. And I certainly reflected a lot of my career, and I did mention in my opening remarks, I started my career as a research scientist, and I worked for almost a decade as a research scientist, and then switched over to finance. And so that probably had a pretty profound impact on how I think about career management. That in my mid-30s with 2 children under 5, I changed career from a mid-level executive to a very junior individual in finance, but I say it worked out okay in the end. So I'm always loath to give advice, but people ask me, what did I learn from this? And I say 3 things. One is listen. Rarely do you know the most of anyone in the room, and just listen. And having changed careers and having gone through my career here up to where I am today, of just taking the opportunity to listen to people. In your career, take risks. And sometimes you have to take risks in yourself in changing careers. And one thing that has really taught me over the past couple years, and I see leaders that I really respect over the past couple years, real examples of leadership, of people who can operate in ambiguity. There is no playbook right now on how to come out of COVID. There's no playbook on how to manage a organization coming out of a pandemic against an inflationary backdrop. And some people are paralyzed, and other leaders say, well, we will just get on with it. And it's been tremendous to watch people who I really respect, just in the ambiguity, in many ways the fog, just lead.
Okay, well, lead. Just lead, listen, and surround yourself with good people. Always good advice. We are at the end of our session. I'd like everybody to join me in thanking John Graham, CPP Investments CEO. Thanks for your time.
Thank you.